Hello everyone, welcome to Certified Business Solutions. My name is Lucy Maina. Today we will talk about how to manage risk in your business. When risk is managed well, your business will thrive. But when risk is mismanaged, your business will collapse. Stay tuned and learn more. How are you, Dr. Kamau?
Fine, thank you, Lucy.
You're well?
Yes, I'm well. How are you?
I'm very fine.
Yes.
What do you think about that statement?
Yes, it is true.
It is true.
That when risk is managed properly, the company can thrive.
Yes.
Because it will avoid the pits and traps that risk might lead the business into.
Okay.
But when the risk is not managed properly, it will definitely make the company to collapse.
Okay.
A case in point is where last week one of the insurance firms collapsed. Invesco Insurance firm. It collapsed, and the reason it collapsed is because it was unable to pay the claims that its policy holders had wanted the company to pay them to a tune of 53 million.
Okay.
So the question is, insurance firms are the ones that are supposed to manage risk on our behalf. Because the way insurance firms operate, if I have a car and I'm afraid that it might be vandalized or it could be stolen, then I insure that car. So by insuring, I'm transferring the risk from myself to the insurance firm. So it is a bit strange where now the insurance firm is not able to manage the risk itself.
And it is supposed to manage for itself and for yourself.
Yes. For sure. It's like now us or myself as an accountant, I come to you and tell you that I'm a qualified and competent accountant. And all of a sudden, you realize that I'm not even able to do my accounts. To keep proper books of accounts for my firm. If you come to me telling me that you have received a letter from KRA and you would want me to assist you on how to apply for a waiver or how to apply for a payment plan or how to go about it, then I tell you, you know what, even me,
I received it.
Would you continue
Definitely
to engage me as your accountant?
No, I wouldn't, because as an accountant, you should not be in such a mess.
You should not be in such a mess. So actually, there is someone who wanted to start keeping fit in terms of managing the body weight. Then he goes to a trainer. Then when he told the trainer that I'm having a challenge reducing and managing my weight, even the trainer said, me too.
The trainer.
The trainer said he was also having a challenge managing his weight. But you see, now this person had gone to the trainer as an expert, as a professional. So when insurance firms are unable to manage the risks by themselves, then it's a big concern.
It is.
So what you would want to understand today, what made Invesco to collapse?
What made it to collapse?
There is something called information asymmetry. Information asymmetry happens when one party in a transaction, and this transaction has got two parties, let's say a buyer and a seller, but one party has more material knowledge and information about the subject matter of the transaction than the other party. For instance, I have a car and I want to sell my car to you. In that case, I am the seller and you are the buyer. So if my car has a problem of a leaking engine, I will ensure that I take it to a very nice car wash and it is done a good engine wash. So that when you are coming to view my car, you will not see any trace of leakage. And I will tell you this is a very nice car, the performance is good, ABCD. So you will be tempted and we will be convinced to buy my car. But you see, you have not given you the proper and all the information that you need for you to make the decision. So that's called information asymmetry. When one person to a transaction has more material information than the other.
So now in the case of insurance?
Now, in the case of insurance, it happens when there's something called information asymmetry is further divided into two.
Okay.
We have adverse selection and moral hazard.
Okay.
Adverse selection
Yes.
is when now the insurance firm, Invesco in this case,
Yes.
when it was actually offering insurance services,
Yes.
in terms of offering protection in case a risk happens to all the motorists in Kenya.
Motorist, sorry.
No, I'm giving this as an example. It was offering other products.
Okay.
But now the main product that made Invesco to collapse is its insurance
For motorists.
Okay. The category that it was offering for motorists.
Okay.
Now, when an insurance firm is attracting, is offering insurance services to motorists,
yes,
it expects all motorists from whether it is from any age, from any part of the country, from any profession,
yes,
to do what? To enroll and subscribe for that insurance service.
Yes.
Now, so someone who is driving a Prado can insure, someone who is driving a tractor can insure, someone who is insuring a small car can insure, someone who is doing a taxi can insure, and someone who is doing even boda can insure.
Yes.
But now, that's the perception, or that is the expectation of the insurance firm. But now, when only the drivers that are driving public service vehicles,
yes,
PSVs,
yes,
are the ones that are coming to enroll for your service, then you have a problem. You have a problem.
Yes, yes.
The people who are self-driven, those we call personal cars, they don't want to come to insure with you.
Yes.
They want to go to insure with another company. The people who have who we can refer as low risk drivers, they are not coming to your farm. Your farm is only attracting the high risk drivers.
Yes,
and
yes,
these
yes.
are the PSV drivers,
the
boda bodas.
Yeah.
So there is adverse selection.
Okay.
Because the way an insurance firm operates is that if it insures 100 people,
yes,
and it collects premium from these 100 people, it expects that out of 100 people,
yes,
only maybe 20 of them will cause an accident and will come to claim money.
Yeah.
So if it had insured 100 people and it had collected maybe 5 million, so if only 2 people or 20 people come to claim,
yes,
and out of the 5 million, it gives claims of about 2 million, it will be left with a profit of about 3 million.
Yeah.
But now when you only attract those people who are high risk drivers,
yes,
so the ones who will come to claim after an accident has happened,
yes,
are even almost like 100%, because you chose from
the high risk
category.
Yeah.
The low risk drivers did not come.
They went to
insure.
Another insurance firm.
Yes, and why are they going to another insurance firm?
Yes.
Is because you have a habit, you have a culture of attracting the high risk drivers. So the low risk drivers, they perceive you as a very risk insurance service provider, because it is a time bomb.
Yes,
if you highly insure the PSVs, the matatus, and they are considered as high risk drivers.
Yes.
So me, if I own a Prado, I will be a bit concerned, and I would want to avoid insuring with you.
Yes.
And go to another company,
because I will consider you a high risk
insurance firm.
So I'd rather go to a low risk
insurance firm.
Okay.
Like now the top tier insurance firms that we have in Kenya, like ICA Lion. So you'll find the ICA Lion is attracting low risk drivers.
Okay.
It's like even a school business.
Yes.
You will find that a school that has a culture of performing very well,
yes,
like even the national schools that we have, they have a tendency of attracting the best brains we have
yes,
at the end of every year when the KCP is announced. But a school that is performing poorly, always the people who get very low marks in KCP, they get admitted in those schools. So it is a culture. So I think for Invesco, for the longest, it has positioned itself as the company that is attracting
the high risk
drivers.
Okay.
Through a concept called the adverse selection.
Adverse selection.
The low risk drivers, they go
to other firms.
Yes. Okay. Now there's also there's a concept called the moral hazard.
Yes.
Moral hazard is when the doer of the action is not responsible for his own actions.
Okay. The doer of the action is not responsible for
his own actions.
Okay.
It's like now when insurance firms, they rely heavily or they are given businesses by insurance brokers and insurance agents. So the work of an insurance broker or an insurance agent is to vet any prospective insurance holder or someone who wants to be a prospective policy holder. Someone who wants to be insured. He would want to know if it is a car that you want to be insured for, then you should know whether you have a history of making accidents and what kind of a car it is. Because if the car is old and unroadworthy, it is likely to cause accident. It has no proper brakes, it has no lighting, it has, even the engine is not in good condition. But you see these agents and brokers, what they do, they just tell you, give me a copy of your logbook, a copy of your ID, ABCD, and you ask them whether they need to come and assess the car. And they say, no, we will come to assess the car in case you get an accident. Okay. So if they will take every Tom, Dick and Harry. They will insure every Tom, Dick and Harry. Sometimes even there are cases where it has been reported that someone insured a non-existing asset.
Serious?
Yeah, serious. So when now the car vanishes, now that's when now the insurance
So first of all, the car was not there.
The car was not there.
And then after we have insured, after some time we'll say that we cannot find the car.
Yeah, the car has been stolen. Now that's when now they are coming to trace it and working backwards. So it is moral hazard when an insurance agent or an insurance broker, him is interested with the insurance commission that he will get after referring a potential insurance client to the insurance firm. Because we start with the insurance firm, then below it we have an insurance brokerage firm and an insurance agency firm. So those are the ones who look for clients, and then they provide they forward these clients to the insurance.
So in short, the moral hazard means that of course the broker will not suffer because after getting the commission, they will go look for other cars. So after the accident, the insurance is the one that is going to suffer for that action. And
the broker, the agent is nowhere to be.
All caused by the broker. Okay, I get it.
Same thing. So the insurance firm is getting a challenge from two ways. Number one is from the brokers and agents, the ones who are referring clients to them. Number two, once a client has been insured, then he becomes more relaxed and less concerned about the well-being of this car.
Because it is insured.
Before, he wouldn't drive into some funny places, into some funny places, maybe into the slum area, because he fears that his car could be vandalized. Some side mirrors could be removed, some lights and all that. And no, after insuring, no, he doesn't care. Even he can go to any place and park his car, even overnight, because he knows my car is insured. In case it gets lost, in case it is vandalized, then I just need to inform my insurance broker or agent, or go directly to my insurance firm and claim for compensation. So moral hazard happens to an insurance firm in two ways: through the brokers and agents, and through the client himself. Because he changes the behavior
after getting the vehicle insured.
Okay. And it is the same thing that we find that once the same thing when you are hiring an employee, the employees will come for an interview. Probably you will get 10 of them, and then all of them have college degrees,
yes,
or they are qualified in
yes,
terms of paperwork.
Yes.
But now, what will happen is that the company is likely to choose the one who is charging the least. Maybe it is most of them are charging 20,000 per month.
Yes.
And now you will go for the one who is charging less than 20,000.
Okay.
Because that is the only way you are left to choose which one to hire.
Yes.
So you go for the one who is charging 15,000.
Yes.
Only, but the one who is charging 15,000
yes,
knows that he has a weakness, knows that he doesn't keep time, he doesn't finish assignments on time, he has a problem, he has been trying to look for employment in other firms, but he has not managed to be hired. So he lowers his fee, but it's because he knows he has a weakness. So
as a company,
you take him and you dismiss the rest.
Yes.
So that's adverse selection. But this person probably, if you had done some due diligence, maybe this guy even he has a record of he doesn't even have a good conduct. Probably he has past bad history or bad record about his behavior. He has a criminal record and all that. So later on, even probably the guy drinks, he's alcoholic, but you might not know the first time that he's presenting himself. Only for the guy, probably the time he gets paid or he gets some income, that's now when you realize the guy is coming late, or the guy is not able to work properly.
Okay.
So it's called moral hazard.
Moral hazard.
Moral hazard happens even at the family level.
Yes.
So when two people are dating, a man and a lady.
Yeah.
So a man could be an alcoholic.
Yes.
A man could be a womanizer. But when during this period they are dating,
the courtship time,
they are courting, he will not reveal this character.
No.
He will not reveal. You will be thinking this is a brother to the guardian angel. But wait until now you have settled, you have the first kid, the second kid, maybe the third kid, then you start seeing the true colors of this guy.
Yes.
He doesn't come home on time. Sometimes he spends a weekend out of your house.
Drinks.
He has some friends, he's receiving some funny calls at night and all that. Now that's called moral adverse selection. Adverse selection. Because this lady, if he had known the character of this person, she would not have chosen to settle with him. So adverse selection.
Okay.
And now it leads also to moral hazard, that this man is misbehaving because he knows that the consequences of his action, he's not the one to bear. Actually, it is the woman who is getting embarrassed.
Yes.
Him is not embarrassed when he goes to work, badly dressed, poorly dressed, he's stinking alcohol. The woman actually feels embarrassed on behalf of
the husband.
It's moral hazard.
Wow. Okay. So that's what most businesses suffer.
That's what most insurance firms suffer. That even every other business. You know, we are only using the case for Invesco as a case in point.
Yes.
But generally, all businesses suffer the same fate in terms of adverse selection. Just as you have seen, even families suffer from
adverse selection and moral hazard.
And moral hazard as well. Same thing for schools, supermarkets, name it. Any business will suffer. So it is good for the managers to be aware of these concepts, to be aware of this kind of situation and circumstances, so that when they are aware, they are able to mitigate risk.
Okay.
So you get someone who is charging 15,000, and now you'd want to dig more. You don't just want to trust this person by the face value. So if it is the insurance firms, there's maybe one particular a broker or agent, insurance agent, who is usually very active. He's bringing, he's making a lot of sales. But now you would want to question that character and wonder, is he bringing us the right clients, or is he just bringing because he knows in case of a claim, he will not be there? adverse selection, moral hazard.
Okay.
And that's what made Invesco to collapse.
Okay.
Because now the drivers of matatus would drive recklessly. If it is, they would be concerned about maximizing profit. They would aspire to make as many trips from maybe Githurai to town,
and from town to Githurai,
so that they make as much money as possible. But in the process, they might even cause a road accident. Someone is killed. And now, who is to pay for that to compensate the deceased family?
Invesco.
It is Invesco. It is the insurance firm.
That's why they had all that claims. That's
why the claims were skyrocketing every other time. We say businesses don't go wrong. Or when you say a situation has gone wrong, it is not that it has gone wrong. It started wrong.
Okay, it started wrong.
It started wrong. From the point that you are doing selection of the kind of the clients and the quality of these clients that you want to insure. If you are insuring bad clients, then it's a time bomb. It's a time bomb. So it destroys your reputation. So with time, you'll find you're only able to attract those people who are doing what?
Who are high risk.
Who are high risk. And you need them in the short run to be able to pay for your operations cost.
But in the long run?
It's a different story.
Okay. That's okay. So my other question is, what do you think Invesco would have done better? Maybe the management would have done better to prevent the collapse.
To prevent that collapse. It's a very good question. It goes down to something called delayed gratification and instant gratification. Even right now, I see young people. They don't want to. They don't want to subject themselves to pain. If they get the salary, they go to entertainment joints, they have fun, they say you only live once.
YOLO.
YOLO. You only live once. But if these young people would be futuristic, future-oriented, they invest in themselves. Because it's Warren Buffett that said the best investment you can do is investing in yourself. They go back to school, they upskill themselves, they get more knowledge and expertise and all that. So what they would be doing is increasing their capacity to earn more. But of course, it means they have to sacrifice themselves. To sacrifice not going out with their friends. But them, they say, we go kupiga sherehe. So the same thing, Invesco. What it should have done, it should not have concentrated so much on profit maximization, because profit maximization is you want to report the highest profit you can. As much profit as it is possible. And how does a company do that? It does that by ensuring that it raises the sales and lowers the expenses, because profit is sales minus expenses. You get profit. So if you want to increase profit, you increase the sales and you lower the expenses. So how would such an insurance firm behave? It would attract premium, insurance premium from every Tom, Dick and Harry. If it is a border that needs to be insured, if it is a matatu, a 14-seater, 29-seater, 16, anything that has 4 legs, they would insure. So that they do what? They maximize on the sales. First, they increase the sales. Because their sales, insurance firms' sales come in form of premiums. So they insure without even doing a proper vetting. Because they are being referred clients by the insurance brokers, the insurance agents, who again we are saying their main focus is the commission they are getting. They are not they are not concerned about the moral hazard. They are not concerned about the adverse selection, because once they recommend,
they get their commission. So the higher the number of clients that you refer, the higher the commission that you get.
The higher the commission.
So your work, their work, is to concentrate of bringing more and more people without proper vetting.
Without proper vetting.
Okay.
Without assessing the risk profile of this person.
Yes.
Because a person with high risk profile should be charged more. So then they just
take them.
Yes. So sales up.
Yeah.
How do they manage expenses? They ensure that the way every car at the dashboard, there's an insurance sticker, and it says, what does it say? Do not accept liability. You go read. The insurance firms advise the drivers not to accept liability.
Even if you're the one who has a...
Yes. And I find it very, very strange and very absurd. That I know it is the brakes of my car that has failed, and I have knocked that other car that was in front of my car. And now, because the sticker of my insurance says I should not accept liability, I deny and deny. Wow. So they advise their clients not to accept responsibility. Them too.
They will not accept.
They will not accept responsibility and liability. So they try to minimize the number of genuine and valid claims. So that they reduce the expense. And once the expense reduces, profit is high. So obsession on profit maximization. But what does that do to the company in the long run? These sales that you are receiving from every Tom, Dick and Harry without proper assessing of the risk profile of this client, eventually they increase the volume and the amount that you need to pay in terms of claims. Because if these are high risk drivers, they will cause many accidents. The car themselves will be damaged, and will have many fatalities. And all of them, it is you to pay. So all the sales that you had generated, all of a sudden they
got to pay claims.
So maybe last year you had a good profit, but the following year, when now claims start to trickle in, you are likely to collapse. Even in terms of expenses, you have refused to pay some claims. So even your reputation, your image in the industry, it goes down. So obsession on profit maximization at the expense of what? Of the image and reputation of the company. What should they do instead? They should do something called wealth maximization.
Wealth maximization.
They should be interested and concerned more about wealth maximization of the company shareholders as opposed to profit maximization. Wealth maximization is when now you are concerned about the long-term welfare and well-being of this company, the long-term goal. Because if I just agree to insure every Tom, Dick and Harry, but am I asking myself, what if the claims go up? I'm likely to go bankrupt. You get the point? It's like now you have a car today, or even we use that example of a matatu. For a person who is profit-oriented, who wants to maximize the profit, now he will not even take that car. He will not even take that car to have to be serviced, the engine to be serviced, because you want to save on that cost and time. On that cost on time. You also don't want to ensure that the car, if it is a matatu, you don't want to invest in terms of ensuring that your matatu is more attractive than the rest of matatus.
It is in good condition.
It is in good condition. So you even if you don't take your car for service, you don't change oil. You don't you fuel in every petrol station. You don't choose even the petrol station that are you feel maybe the source of their fuel is not credible. You go there. So at the end of the day, your car does what? The engine knocks. And you are forced to change the engine. Because when the mileage, when you are supposed to service it after maybe 10,000 kilometers, you did not do that. You waited until the car had covered about 50,000 kilometers. Then eventually the engine knocks. So even you are unable to buy a new engine. So you have to park your car somewhere and receive no income.
Yes. And so go maybe borrow or look for money elsewhere.
As you go borrow and look for money elsewhere. So at the end of the day, what you thought that you are maximizing profit, actually it ends up being a challenge to bringing a challenge to the existence and the continuity of your business.
Yes.
So wealth maximization. Wealth maximization is if it is a company. If it is a company and this company wants to reduce even the profits for the profits in the short run, so that it can do what? It can create more and better capacity for more production and better production in future. You get the point. So for instance, what I had said, that you deny yourself going to the entertainment joint as a young person. Instead, you invest in reading, in learning. So what you are doing, the quality of your life at the moment, someone might think it is, of course, it is not good. Because they are not seeing you in the entertainment joint. You're not driving a nice car. You're not living in a nice neighborhood. Compared to your peers.
Colleagues,
But what will happen 5-10 years from now? Them, they will still be in the same places. Probably your capacity and your production power will have increased. You will have been able to possess and to attract better paying jobs or even businesses. So that time, if these guys were being paid 20,000, they're still earning 20,000. But no, you are earning to a tune of 200, even to 500,000 per month.
Yes. Because you invested in yourself.
You invested in yourself.
You sacrificed.
You sacrificed. Wealth maximization. So a company should not cut shortcuts in terms of who it needs to insure. It should only insure low risk clients. And if it has to insure high risk clients, it needs to charge more premium than the low risk. But when you charge every Tom, Dick and Harry a blanket rate, equal rate, it is a disaster. So wealth, you better not earn much profit today, but you are doing that for the sake of the company, for the sake of the future. But you want everything today, then you collapse.
Okay.
So what should they have done differently? Not to be so much obsessed by profit maximization, but wealth maximization.
And this cuts across all companies.
All companies. Businesses, even individuals. Individuals, that's when we talk about instant gratification versus delayed gratification.
So instant gratification is when you want to be recognized there and then.
Here and now.
That time we are drinking.
Yes. You are banjukaing, you are having fun.
Okay.
That is the time that you are now being obsessed by having it all today and now and here versus now investing for your future.
Okay. So what do you think other insurance firms or any other company can learn from Invesco?
Yes, it's what I would say is there's something called modern portfolio theory. It is a concept that was founded by someone called Harry Markowitz. And Harry Markowitz said that he was addressing the issue of risk and return. Risk and return, because in every business, in every transaction, there's a trade-off between risk and return. And we say the higher the risk, the higher the return. So in the event that a company is faced with different options, investment options, investment option A, B, and C, and all have the same risk.
All have the same risk.
Then a rational, savvy, and shrewd investor should go for the option that gives him the highest rate of return, because all these options have the same risk. So a rational investor should go for the option, investment option that will give him the
highest return. Okay.
And vice versa.
Yes.
If you are faced with investment options that have similar rate of return, you should go for the option that has the highest or the lowest risk.
Come again.
If you are faced with 3 investment options that share a similar rate of return, you should choose which option, the one with the highest risk or the lowest risk?
The lowest.
The lowest risk.
Yes.
Exactly the point. Now, Invesco, when insuring motorists, whether they are referred as a personal car.
Yes.
And insuring matatus, PSVs. And insuring maybe a young person.
Yes.
And insuring a married person. You know, a young person who have just acquired the car, for the first time, should be charged
at a higher rate,
more premium than an elderly person.
Yes. Because of course the one with the family,
will be more responsible.
Circumstances will have to be responsible.
But insurance here in Kenya, they are not keen on that because I'm a living example.
Yes.
The first time my first car crashed only 3 months after I had acquired it.
3 months.
And it was written off.
Wow.
So the insurance firm that had insured me, because it was a comprehensive cover, they had to compensate me fully to buy another car. So I got another car.
Yes.
The second car that I got, and the insurance firm did not bother to ask to look at my accident history, whether I'm a safe driver or I'm a risky driver. So I was just insured at the same rate I was insured the first time. And guess what? Even the second car,
happened again.
It crashed.
Wow. Until you started, until you started a family,
Yes, until I started a family, I became a bit more responsible.
Yes.
And it has been more than 10 years since then. And I've been responsible even in every other thing that I do. So insurance firm should ensure that for a risky client, they should be charged more premium.
Than the low risk.
Than the low risk. So that's what I would advise the insurance firms, because it is very sad that when one insurance firm collapses, we are likely to experience something called the contagion effect. Contagious, something that is contagious, but not the effect is called contagion effect. Contagion effect is not when something happening to one of the insurance firms now happening to spreading across
the other
insurance firms. We may not see other insurance firms collapsing, but we are not likely to see the growth in the insurance sector. Like now today, the insurance penetration in Kenya is at about 2.3%. Insurance penetration means the amount of money or revenue that insurance as a sector is contributing to the entire GDP of the country.
It is 2.3%.
It is at 2.3%. There's a time it used to be at 3%. Instead of becoming better, it is going lower. Why? It's because people are continuing to lose confidence in the insurance firms that we have in Kenya. Why? Because when an insurance like Invesco collapses, if you had put a claim of about 5 million, the maximum that you can get paid is 250,000.
But then that's a question that I wanted to ask.
Yes.
Because I know there are some people who had insured
with Invesco.
Yes. Not only in PSV.
Yes.
So will they get compensated?
Yes. Even maybe in PSV, and assuming someone was knocked down by a car, by a matatu. And the deceased family has won the case against the insurance firm, and they need to be compensated about 5 million. Once an insurance provider collapses, the maximum that a claimant can get paid is a maximum of 250,000.
And who will pay? Because the insurance already has collapsed.
Yes, all insurance firms contribute some money to the regulator, Insurance Regulatory Authority of Kenya, and the Insurance Regulatory Authority of Kenya maintains something called the IRA, maintains something that is called the Policy Protection Fund, Policy Holders Protection Fund. So when an insurance firm collapses, the claimant will be compensated from that kitty, but to a tune or to a maximum of 250,000 per person.
Well, that is too little.
Yes. So when we keep asking ourselves why the insurance sector is not growing, that is that is the major reason.
Yes.
Because now you would get scared that if you go to any other insurance firm, you are likely to suffer the same consequence. The insurance penetration rate in Africa is at 3%. 3% higher than the one that you have in Kenya.
2.3%.
So we are underperforming as an insurance sector in Kenya. The global insurance penetration rate is at 6%. So we are significantly underperforming.
Okay.
So what I think even the insurance as a sector, the CEO or the IRA would have done is to prevent any insurance firm from collapsing.
No, to prevent them from collapsing is by supporting them.
Supporting them and even coming up with stringent policies to ensure that they would say that for you to start an insurance firm, you need to have 1 billion.
Okay.
Yeah, to have a capital investment of 1 billion.
Yes. So
that you demonstrate that you have the financial strength and capability to pay claims when and as and when they arise. But when every other Tom, Dick, and Harry is allowed to start an insurance firm, and when claims come, then if you don't have a strong financial muscle, you will not be able to pay.
You will not be able to pay.
You will not be able to pay. So they can increase the capital requirements for that firm. They can also come up, like now there is a policy they came up that an insurance firm that is offering general insurance services and life insurance services, it should, that no company should offer both services as an entity.
Okay.
If you want to offer general insurance services, you need to register a different insurance firm separate from the one that is offering life insurance services.
Okay.
As a way of mitigating and managing risk.
Okay. So that in case this one collapse, it will not affect the other one.
It will not affect the other one.
Okay.
In terms of the commercial banks, they manage the risk in a better way. Because if the CBK governor today realizes that people are are sharing information that a certain bank is likely to collapse, the CBK will come very strongly and dismiss that kind of news. And if it continues to something called the bank run, the CBK governor will issue a directive saying that no person should be allowed to withdraw his deposit in that bank to more than 2,000 or even 5,000. They limit.
Yes. Actually, I think we have had such cases.
Yes, they happen every now and then. Even before Chase Bank collapsed, that's what had happened.
Okay.
The CBK governor had put a limit to the amount that any depositor could withdraw. Because by doing that, they protect the bank from collapsing, and because if that bank collapses, then we will have something called bank panic. Every other depositor will go to his respective bank and withdraw money.
Oh, that one is the one that we are also talking about,
contagion effect. And it's called the self-fulfilling prophecy. That someone somewhere in the social media started saying a certain bank is likely to collapse.
And it
was just a joke.
A joke,
Then before we know it,
all banks are following that trend.
Yes, and once the financial system falls, the entire economy collapses.
Wow, okay. I see. Thank you very much. I think, we've had it very well. Business people should watch out for the moral hazard and adverse selection. And also, business should focus on wealth maximization rather than
profit
maximization. Thank you so much, Dr. Kamau. Our viewers, we hope that you have gotten something. Please leave a comment and subscribe to our YouTube channel. We will continue sharing more and enlightening more videos. See you next time.